Viewers, I, Sanjay Agarwal from the SciTex Committee, Chairman of the SciTex Committee, welcomes you in this interactive program with the cooperation, with the planning, with the everything from the Singapore chapter of ICI. And today we have the chairman of the Singapore chapter with us, Mr. Ramki, who will be leading and is the brain behind everything. Today, what you will hear, and I'm sure that office have told me that we have crossed 700 prior to 10 minutes of this program, and by the time we progress, I think the thousands figure we are going to cross it. At the same time, I welcome Shri Hitesh Gajaria ji, CA Uday Ved ji, CA Rohan ji, and the moderator of the program today, Rishabh Agarwal. And I think the office will also appreciate this thing that the queries are taken, the interaction is also there, and the topic which we are going to deal today in this has a prospect of the tax treatment and challenges for India investment. Today, India has become also an investment partner everywhere in the world, and the incentive by India for foreign investment and areas to be kept in mind while making the investment abroad. Because a lot of time we go and we invest, but we do not know that what are the nuances, what are the various formalities which are required to be taken care in the local laws also. And in case of anything happens bad, how the liabilities are to be restricted. Because as we have in India that a 7-year, 6-year window for the cases to be reopened, the speakers and the panelists will look into this matter also.
I think he just froze because of the network. You can.
Why don't we move on to the next
today?
Yes.
Today, friends, we will be having the viewers from both India, Singapore, and other parts of the country also, and from the abroad also. As we have discussed in the meeting that this is popularized in all over the world, wherever our members are there. And with this background, I hand over the mic to Ramki boss, and please take over the next of the proceeding. Thank you very much for giving us this opportunity.
Thank you, Central Council Member CA Mr. Sanjay Agarwal ji. Welcome to this webinar on international taxation focused on Singapore and India, brought to you by the Committee of International Taxation ICAI and ICAI Singapore chapter. I wish to mention that Singapore and India, as we all know, share special economic, cultural, political ties for decades. Singapore is often referred to as a unique first world city-state, a red dot, and a gateway to Asia Pacific. It has a population of 5.7 million and a very small land area of 700 square kilometers and a GDP of $400 billion, which is approximately 10% of India's GDP. But if you look at the extent of trade and commerce, people ties, and various other exchanges between the two countries, it punches far beyond its weight. I think we have key agreements between two countries that includes CECA, Comprehensive Economic and Cooperation Agreement, signed in 2005, as well as the Double Taxation Avoidance Agreement from 1994, and that has been subsequently amended. Furthermore, Singapore is also seen as a financial hub for Asia Pacific, wealth management hub, a center for litigation, a center that is known for governance, transparency, and much of all this. And today's discussion is really around the next level, which is about international taxation between the two countries. And as Sanjay Agarwal ji said, there is a lot of finer details that we could discuss for corporates, for individuals between the two countries. And We will go into further details. We have experts in the form of Rohan Solarpurkar, who was the past chairman of ICAI Singapore chapter. He's a partner with Deloitte, as well as two eminent speakers from India, Hitesh ji and Uday ji. So with that, let's look forward to a engaging discussion on international taxation with focus on India and Singapore. Over to you, Rishabh.
Thank you, sir. I acknowledge the presence of all our speakers, two from India and one from Singapore, the Singapore chapter chairman and the chairman of the Committee on International Taxation of the ICI. So before we begin, as rightly said by Ramki sir, that India has been a very major and a crucial trade partner, and that is why we decided upon selecting India and Singapore as a bilateral exchange of knowledge per se on taxation over here. And with this backdrop, we would also see what are the basics of Singapore taxation a little bit, and then we'll go on seeing about how the double taxation treaties function in here between India and Singapore. What are the critical issues over there? Then touching upon the latest discussion of Pillar 2, which has I think today has been also been approved in the EU Council today. And so we will try and discuss all the issues and take up the questions from the audience over here. So I would initially like to welcome Rohan sir and give you a formal introduction so that we can start with the overview of Singapore taxation a little bit. So Rohan sir has experience of more than 25 years in international tax and has been a tax leader for consumer products and retail industry across Southeast Asia. He has advised many multinational companies which have their regional headquarters and their headquarters based in Singapore. And also he has worked with many other industries. He has been a regular speaker and also held the position of the chairman of the Singapore chapter of the ICI. So Rohan sir, over to you for the overview of Singapore taxation, and subsequently we'll welcome our other speakers as well.
Right. Thank you so much, Rishabh, for the kind words and the introduction. Singapore and India, when you talk about tax and trade, always evokes a high level of interest among the audience, right? Because very often and increasingly we've seen investments coming in from Singapore into India. And Singapore, as I understand, perhaps maybe the largest investor now as in terms of FDI coming into India. And we've also seen a fair amount of interest, especially from the startups, the fintechs, trying to flip structures or create holding companies in Singapore from a tax perspective or from an IP perspective, IP holding jurisdiction, because Singapore has a strong regulation in the context of intellectual property. But, from a income tax perspective, before we delve into all of the details of when we open the floor up for discussion, just a quick synopsis, right? So Singapore follows a territorial basis of taxation. But what that essentially means is that income that is sourced and derived in Singapore is taxable in Singapore. Offshore income or foreign income, by very definition then, is not taxable in Singapore, unless under certain circumstances, that income does get taxable in Singapore. So, for example, if there are dividends which come in from a low tax jurisdiction, which have not been taxed. So let's say if you have dividends coming in from Dubai or dividends coming in from Cayman Islands, flowing into Singapore, that becomes taxable in Singapore. So, but the basic concept is that only Singapore sourced income is taxable. There are certain other sort of conditions that prevail around dividends, which I alluded to earlier, or service income. So if I do render services offshore, typically that service income will not be taxable in Singapore. And that will not be taxable in Singapore only if you are able to create a permanent establishment offshore. If there is no permanent establishment offshore, then that service income is deemed to be sourced in Singapore and taxable in Singapore. If you have a branch offshore, then the branch is considered a permanent establishment and therefore not taxable. The profits of the branch are not taxable in Singapore. So that gives you a broad sense of what is taxable in Singapore. What is not taxable in Singapore is capital gains, and which therefore tends to lead to a lot of great and creative tax planning opportunities. So capital gains is not taxable in Singapore. There are certain safe harbor rules in order to try and identify what constitutes a capital gain and what constitutes revenue gains or revenue income. But we won't get into that because that gets that can have its own sort of course of discussion. But suffice to say that capital gains in principle is not taxable in Singapore. From another perspective, what is also attractive in Singapore, apart from it being a financial hub, a banking hub, and you've got plenty of fund management incentives or incentives for financial sectors happening in Singapore. We also have a multitude of incentives that are applicable to, let's say, the maritime industry. So if you've got shipping has incentives. If you've got airline leasing, you have tax incentives for that. You have tax incentives for trading companies, which is called the Global Trading Program scheme. You have tax incentives for companies which set up international headquarters in Singapore. You have tax incentives for companies who are doing cutting edge technology and innovation in Singapore. So all of this is monitored by two sort of regulatory bodies in Singapore called the Economic Development Board, one, and the other one is Enterprise Singapore. So these two bodies are sort of given the control, the authority, and the power to sort of discuss and negotiate tax incentives with taxpayers. So this is not done by the tax authorities. They are done by two separate authorities, as I mentioned, the Economic Development Board and the Enterprise Singapore. And whatever ruling they give is then sort of followed by the tax authorities, which is the IRAS, which is the Inland Revenue Authority of Singapore. Generally, these incentives have two parameters. They look at the qualitative aspect of the investment and they look at the quantitative aspect of the investment. The quantitative aspect being what's going to be the turnover, how much are you going to spend in Singapore, how many jobs are you going to create, etc. So that's the quantitative measures. The qualitative measures is what is in it for Singapore, right? So is it in line with Singapore's policy in terms of which industries they want to believe in, or which industries they think are the industries of the future, and is aligned to Singapore's economic development and growth. So they look at all of that and then decide whether they want to give an incentive or not give an incentive. So it's not necessarily to say that, I'm going to invest $200 million or $500 million or $1 billion, and therefore I should be eligible for incentive. They may come back and say, sorry, it doesn't align with our philosophy and policy. Very good, and thank you very much for your investment, but it's not aligning with our policy at this point of time. So it's not necessarily only monetary terms that will drive that decision in terms of tax incentives. The types of, as I said, that if you look at shipping, right, the shipping industry again has a different set of regulations and incentives that's governed by the Maritime Port Authority of Singapore, which is called the MPA. And they also sort of encourage a fair amount of shipbuilding activities or investment into construction of ship and vessel building. And coupled with that, they also are sort of eligible or able to give incentives from a tax perspective, which means that there could be exemption on withholding taxes on funding and financing and borrowing, all of that. So that's sort of pretty much a quick synopsis of how Singapore works from a tax system. We could have a larger discussion and we can have this more interactive as we go on. But, happy to take some questions at a later point of time. Rishabh, if you think we have more time to talk about the overview of Singapore, I can give a further detailed discussion. But happy to, pass it on back to you and for Uday and Hitesh to comment on everything.
Thank you, sir. I think it was a good introduction so that our audience is also, a little involved on what and how and what is the scenario of the discussion. And before we move ahead, I would like to acknowledge the presence of the Vice Chairman of the Committee of the International Tax. Kotha sir is also here. He has joined us.
Good evening, all of you. Namaste.
Okay. Thank you, sir.
Maybe one aspect I missed out, and perhaps I can comment on, Rishabh, before we move on, time permitting, is on withholding taxes. right? So whenever there are payments out from Singapore to different jurisdictions, as most countries would have, there are withholding taxes. So there is a withholding tax on interest. There is a withholding tax on royalty. Services attract a withholding tax only if services are rendered in Singapore, and dividends do not attract any withholding taxes.
Thank you, sir. I formally welcome our speakers from India, Uday Vaid sir. Uday Vaid sir has been in this international tax or taxation practice since more than 30 years now. He has worked and held key positions at Big Four firms and now handles the global tax practice of the firm KNAV. He has co-authored many publications, and one of which being the General Anti-Avoidance Rules, GAR, establishing a substance over form. He has been regularly nominated as the leading tax advisor in the past decade, and he has given many lectures and webinars, seminars physically as well at various platforms and forums, and he regularly appears in various news forums or media channels as a tax expert, being so long in the industry. And I would also like to welcome Hitesh sir, who has more than 37 years of experience in the field of taxation. He has also been a senior advisor for tax and regulatory practice at at the Big Four, one of the Big Four firms. He has regularly given his counsel on tax and regulatory issues, presented and hosted conferences, webinars, and also authored many publications, one of it being Taxation of Non-Residents on FERA and FEMA, Transfer Pricing Manual, and the famous one being on the MLI. And apart from the academic part and the professional part, he has a passion for singing here. And I would like to give a special mention for it because we professionals often forget our hobbies once we are in the profession. So moving forward, I formally welcome all the panelists and would like to ask Uday sir and Hitesh sir if they would like to comment anything on the backdrop given by Rohan sir, or we can move forward for the discussion.
Can move forward, except that all three of us are very, very close friends for more than 25 years. I can tell you, it's a great coincidence, or the way you selected the panel. Thanks to you and both CA Institute in India and Singapore. Hitesh and I have worked together for many, many years. So is Rohan. So we are dear friends.
Thank you. I'm happy as well to be here together. Let's move on with the conference.
Perfect. So we would like to start the discussion with the most, open and detailed topic about the India-Singapore double tax agreement. So I open the question to all the panelists over here that if they would like to point out some salient features or maybe some practical issues that they've encountered while working on the India-Singapore DTA.
So if I may go first, India-Singapore Treaty was in some senses an improvement to the Mauritius Treaty, improvement from that perspective that it lended a certainty after especially the protocol to the treaty was promulgated. And unlike Mauritius, which continued for a very long time in litigation and continues to be today, I think Singapore was very practical, if I may say so, in negotiating with India, a protocol which laid down clearly what could and could not be expected from the tax authorities, depending on certain objective criteria to be met, the most important of them being the annual spend of 200,000 Sing dollars. Now, obviously, there have again been some interpretations around this, and we will come to that as we go into our discussion further. But I think Singapore Treaty certainly lended an air of far greater certainty and predictability so far as the capital gains exemption was concerned. And in a sense, Singapore, to its credit, also projected itself, rightly so, as a financial destination, as a global hub, and was very careful never ever to portray itself as any tax haven, And indeed, it has been a miracle city-state for the entire world to admire. And therefore, it played up strongly to those credentials. And rightly so, I think, from a pure, let's say, smell test perspective, we found that genuine multinational clients were as happy or more happy if, let's say, they were able to establish substantial operations in Singapore and come inbound into India from Singapore because of the treaty which is present. The only point that I have is still, which is still rankling me at least, is the situation where unfortunately the outbound situation is not that clear, because India's largest trading partner is today the US. And Singapore and US not having concluded a double tax avoidance agreement leads to a lot of withholding taxes being levied, especially in the US, if any flows have to come to Singapore. So I think that is perhaps the only little bit of quibble that I have with Singapore as a destination for outbound investment. With that, I think I will allow Rohan and Uday to have their say.
Rohan, you want to go?
Yeah, I think Hitesh has summarized it very well in the context of the Singapore-India Treaty and how Singapore has sort of managed to, demonstrate that although there is a change in the treaty, which brings about a taxing right, which earlier was not there, and still sort of having investments flow through this country, demonstrates the strength of the, not only the investment climate that is there, but also what Singapore brings to the table. But I think Hitesh's point on the fact of the absence of a treaty between United States and Singapore is baffling to why there is no treaty at one level. But to put it in a different context, and we've had this discussion with regulators also, right? The fact of the matter is that I think from a US perspective, they really are not concerned about it, because US says that we are anyway getting a tax credit back in our home country. That's one. Secondly, from a US-Singapore standpoint, they don't believe that there's so much of trade really happening between the two countries, which is going to sort of help them or go for a tax treaty. They do not see Singapore as a big manufacturing hub or big service hub. They see largely Singapore as a hub for setting up headquarters, and which would then service the region. So they don't really see huge amount of trade happening between the two countries, as a result of which, again, we do not foresee a tax treaty between the two countries in the near future. But over to you there if you have any other thoughts.
Sure. So just to continue, Rohan, from an India outbound perspective, as it is rightly put in, Singapore is one of the key options whenever we have seen outbound investment. And in the US, this issue comes up. We've seen UK as a better location, because in the US UK withholding is a 5% compared to it would be a 30% dividend tax. But in number of situations, particularly for capital gains, US does not tax the offshore gain anyway. So the Singapore may still be an option, but I haven't seen Singapore more as an outbound from the US perspective, certainly in the region. And now with Pillar 2 coming in, and Rohan, maybe we can talk that little later in detail, but just to touch upon it, the 15% global minimum tax, when one looks at UAE versus Singapore from an India outbound perspective, certainly Singapore has, is way more than a 15% base rate. Of course, the final tax liability is relevant, and we'll see how it spans out over a time. So India outbound, still Singapore is, in my view, a very, very important location for investing in Asia Pacific or even in a few other parts of the world. From an inbound perspective, just having done quite a bit of research on the GAR from an India perspective, just the credibility part, when we looked at for last 25 years, funds investing in India or private equity investing in India, the substance over form, and now we have BEPS. India is a signatory to BEPS program. In fact, one of the leading signatories to the BEPS program. Just because of the fund situation, the regulatory framework, Singapore clearly scores over Mauritius at that point of time. Now, of course, both Singapore and India, Singapore and Mauritius treaties have been renegotiated from 2017 onwards. But even from that perspective, and other aspects from a larger business perspective, from investors coming and pulling funds and everything, Singapore certainly is a better location. Even post this change in the treaty changes only the taxation of capital gains on shares. So there are still tax planning opportunities on the other financial instruments. As the webinar progresses, we can talk about it. It's only shares which have been renegotiated.
Just 2 points that I may bring in. Sorry, Hitesh, you were saying something? Okay. There are two comments that I would like to make onto this. And the first one being that whilst we look at it from a treaty perspective, I think what is changing in the Singapore landscape is the term residency and the ability to have real substance in Singapore. Gone are the days where you could have a company that is set up and really have, like a shell company. But now the IRAS is really sort of hammering down to ask, how many employees do you have? Which are the key employees you have? Do you have a CFO? Do you have a CEO? How many board meetings do you have in Singapore? And they are asking for all sort of details in order to decide whether you are a tax resident or not. And therefore, when you look at private equity funds, or if you look at pure having SPVs in Singapore, making investments into India, I think that really becomes a challenge to demonstrate substance, and they are getting quite active on that. And the second aspect, and I'm going to let Hitesh and Uday comment on it a little bit more, is that when we look at it from a capital gains perspective, whether a double-layered structure, investment structure, is going to give us any sort of relief when we make an investment into India. So when I say double-layered, it's a Singapore holdco, which has a Singapore SPV, which has another Singapore SPV below that, which makes the investment into India. Because at the time of exit, then you can have a Singapore holdco selling the intermediate Singapore SPV rather than selling shares of the Indian Indian entity, right? And whether you could still get benefits of the India-Singapore treaty, which talk about sale of shares of an Indian company, as opposed to now we are selling shares of a Singapore company. So I leave it to Hitesh and Uday to sort of react and comment on that.
Sure, interesting question you raised, Rohan. But before that, Uday, I would just like to comment on one other important aspect, contrasting it with Singapore's avowed objective of it being positioned as an IP holding hub and doing a lot of things to actually promote the development of IP, research, etc. Singapore science parks, all of that I have witnessed firsthand, and I'm really proud of what Singapore has achieved in that sense, trying to create an environment. Now, the absence of a treaty with US, which actually is the largest consumer of most of the IP, especially, let's say, take high technology, internet gaming, or take, let's say, cutting edge healthcare, or let's take even vaccines for that matter. The difficulty is that absence of treaty, when Singapore is actually doing all its might to promote IP and give tax holidays and all that gets washed away if I'm going to have a 30% withholding gross basis in the US. So I think even as I understand that US may not look at Singapore as a trading partner, actually Singapore needs to position its intellectual property prowess far better and get that treaty going. That's my point of view. I was not only looking at it from a capital gains perspective.
Right.
The second point on the double-layered structure is, again, I don't know whether double-layered structure post-2017 will continue to give treaty protection, because now as gains are taxable and we have post-Vodafone, the issue where we have even, underlying taxation and indirect taxation in the domestic law. So it depends on the facts of the case, but prima facie, I would say that is adventurous planning. Just merely having a double-layered Singapore structure to try and save capital gains. Uday, over to you.
Yeah, so indirect transfer is clearly applicable, and in fact, CBDT view is that none of the indirect transfer is eligible for the tax treaty. There is a negative ruling of Tiger Global, which does talk about it, though with due respect, I have a different view on that. The treaty has, the Tiger ruling has not gone into the much details except CBDT's interpretation and the beneficial ownership concept. But when I look at the treaty does tend to support. That's my view. The language of the treaty does tend to support that. The recipient being the Singapore, in the India-Singapore treaty should apply. And I think the way protocol has been worded, it is possible to take that view. Having said that, definitely it would be litigative. We'll find out as we see more those, and a lot of those private equity deals will go through it in terms of indirect transfer. But yes, from a planning perspective, whenever such situation is coming, we have budgeted that the tax will be levied. In my view, the treaty language does support even after the change that it should be exempt.
Thanks.
Great. I think, we have received a lot of historical background and the basics, and I would say some critical issues on the DTA. And as Uday sir just mentioned about the beneficial ownership. So moving ahead, I would like to request Hitesh sir to expand a little and share his views about the concept of beneficial ownership in the India-Singapore DTA in the dividends, interest, and the royalty articles, as it is mentioned. So you are...
Yeah, I just put myself off mute. Thank you. So this particular thing of beneficial ownership is something which post the principal purpose test actually will come in for a lot of close look. Earlier we had a condition where, and first before I go to actually analyze, let's analyze what is the meaning of beneficial ownership. And beneficial ownership classically we have seen is provided for in articles of dividend, interest, royalty, and fees for technical services. And this article basically gives a reduced rate for source country taxation only if the recipient of the dividend is a beneficial owner of the dividends. Now, this in a sense is a anti-abuse rule to ensure that only quote-unquote beneficial owners of that income qualifies for the lower rates as set out in the treaties. Now, despite its great importance, maybe the term beneficial ownership itself is fraught with some difficulty and therefore is not defined in the tax treaties. Now, when I contrast the treaty versus the act, it is important to note that in the context of several provisions in the domestic law in India, the domestic law chooses to look at beneficial ownership of assets from which the income comes rather than the income itself. But the articles which deal with dividend, royalty, interest, fees for technical services look at the income concept itself. Now, in general parlance, I can say beneficial owner is one who enjoys the ultimate benefits of something which he is entitled to receive. A beneficial owner, therefore, is one who is free to decide how such income yields should be used. Now, which brings me to the most important distinction that while there could be one legal owner of certain income, the beneficial owner of that income could be an entirely different person. And there is a very salutary Mumbai tribunal decision in Golden Bella Holdings case, where the tribunal accepted the position of the taxpayer, which was a company resident of Cyprus, that the mere fact that that investment was funded using a portion of an interest-free shareholder loan and share capital did not itself affect the taxpayer's status as itself being the beneficial owner of the income, as the entire income was demonstrated to be the sole property of the taxpayer. Second, the tax authorities did not prove, or rather they failed to prove, that the taxpayer did not have exclusive possession and control over that income, or that it was in any way required to seek approval from somebody else to invest in the Indian company, or that the taxpayer lacked the freedom to utilize the income that it so received. So the burden of proof was actually on the tax authorities to bring out how the taxpayer was not the beneficial owner of that income. And therefore, in this case, it held in favor of the taxpayer. So what are some of the learnings from this? And I can quickly sum up. To circumstances, let me give you first where requirement of beneficial ownership to my mind can be said to be met. See, first, an intermediate company can still be the beneficial owner if there are business reasons for it to be so interposed. Secondly, that company assumes complete risks, dominion, and control over the funds that it receives or it invests. Distribution of the dividend income, etc., which is received without any pre-commitment, again does not vitiate a beneficial ownership. Now, merely the fact that the bank account is located in another country also does not mean that that person receiving the money is not the beneficial owner. The relevant factor is the control over that bank account and not the location of the account. But let's also contrast with some circumstances where requirement of beneficial owner can be said to have not been met. So, for example, where dividends are merely received by a person in capacity as, let's say, an agent or a nominee. For example, executor or a trustee holds a legal title for the benefit of somebody else. Or where the recipient acts as a conduit for another person who in fact receives the ultimate benefit of that income. Or more importantly, that recipient is merely a fiduciary person or an administrator of that real owner's funds. Or where facts are indicating that the recipient itself is not in a position to make any decision regarding the utilization of the dividends. The tax residency certificate as a proof of beneficial ownership also plays an important role, especially in the context of the India-Mauritius Treaty. And actually, that is a further discussion that we can have. But I just want to draw attention to Circular 789, issued by the CBDT on 13 April 2000, clarifying that in the context of the India-Mauritius Tax Treaty, wherever there is a certificate of residence which is issued, the same will be sufficient evidence for accepting the status of residence, as well as the beneficial ownership for applying the tax treaty. So with this, I will stop here. I will invite my friends if they have any more things to add on the concept of beneficial ownership.
So Hitesh, you, I think, very rightly summarized. And it is actually, in my view, found now in the amended treaty itself, Article 24A, paragraph 1 and 2, as amended after 2017. In fact, it does make a reference of the shell or a conduit company. Actually, it is defined there, what you said exactly about the business operations. And I'll just read these two paragraphs, which are important only in the context of capital gains, because that's where the term beneficial owner is not there. So paragraph 1 says, a resident of a contracting state, which is Singapore's example, shall not be entitled to benefits of paragraph 4A or 4C, which is that, the exemption prior to 17 or after that, if the affairs were arranged with the primary purpose of to take advantage of the benefits in the said paragraph 4A. That is the principal purpose test. Or the 4C, as the case may be. The second paragraph is exactly relevant to what you said. A shell or a conduit company that claims that it is a resident of contracting state shall not be entitled to the benefits of paragraph 4A or 4C. And then it is defined. A shell or a conduit company is any legal entity, as is just incorporated in Singapore, falling within the definition of resident, with negligible or nil business operations, or with no real and continuous business activities carried out in the contracting. This is exactly the point that you said. There have been, I think, both the competent authorities seem to have heard about what you said.
So one more thing, let me just add, Uday. I'm glad you brought out this Article 24A. here again, in the context of the Mauritius Treaty, interestingly, a case went up to the Mumbai tribunal where the company actually had a valid tax residency certificate. And yet the beneficial ownership was challenged. The beneficial ownership first was tried to be imported into the capital gains article. And even otherwise, the tax residency certificate was looked beyond despite the circular. Okay. And the taxpayer thought that, it's a done deal. We just to show the circular, we are just to show this, particular position that this is what the board has guided for the benefit of of the department. But rather surprisingly, the bench actually referred it back to the AO by bringing out that the assessing officer had not produced enough tangible reasons to go beyond the tax residency certificate. And in a sense, actually gave one more opportunity to the department to see if they could bring out those facts and circumstances which would override the tax residency certificate. And interestingly, that entire judgment reads very well, and it actually has echoes of some European judgments, in which European judgments, borrowing from generally accepted principles in those countries, in the context of their capital gains article, have actually imported beneficial ownership reading into the capital gains article. So borrowing from that, this judgment now gives another opportunity to the department to try and see if there are more facts which can be brought and a reassessment can be made as to whether or not the benefit of the Mauritius Treaty can be given or not. So we are at an interesting junction so far as even Mauritius is concerned. And I remember when I started my practice, Mauritius, was the hot word of the day at that point in time, and MOBA, and, the treaty with Mauritius was the first time that, we had come to know of this exemption. And again, 38 years after that, in 2022, from 1988 to maybe 2022, it continues to still retain its flavor of controversy.
No, there was no BAPS or MLI. Right? After BAPS and MLI, possibly this changes little.
So let me bring about two concepts which I would like to share. Right. So on this beneficial ownership, interestingly, Singapore-Mauritius Treaty, when we look at the royalty clause, under the Singapore-Mauritius Treaty, the royalty is taxable only in Mauritius and is not taxable in Singapore under the treaty. Right? So it throws it back. There was in one of our cases for one of our clients, there was a back-to-back arrangement where royalty was paid by Singapore to Mauritius, Mauritius paid to Netherlands. The Singapore tax authorities took a view that Mauritius is not the beneficial owner, despite Mauritius having a tax residency certificate. And this was because when they asked for the financial statements of the Mauritius company, they saw an equal amount that was received by the Mauritius entity and an equal amount paid out by the Mauritius entity. And that's when the tax authorities in Singapore said, look, prove to me that you are the beneficial owner. And Mauritius couldn't do it because, to that extent, and like Hitesh said earlier, that was not fully developed. So not too many people, not too many employees, etc. But so no commercial substance. So on that basis, the in Singapore. That's the first instance. And this is live case. And the client came back and said, okay, we agree. We were not going to pay any tax on that. The second instance, while we are talking about the India-Singapore beneficial ownership, and to that extent, Hitesh also alluded earlier to the fact that you can have a bank account offshore or, in a third location. But interestingly, the India-Singapore Treaty, Article 24 of the treaty, says that you will be allowed to enjoy the beneficial or the reduced rates of tax only if the income is remitted into Singapore. If the income is not remitted into Singapore, then you will not get that benefit. And the quirk of the law to the extent it's Singapore is that Singapore allows you to say, so let's give you a live example. I have interest, right, on a loan that I have given to an Indian company. Now, Singapore says that if that interest is not remitted into Singapore, I will treat it as foreign source. So the Singapore company can open a bank account in Hong Kong and keep all its offshore income. There's no exchange control in Singapore, so I can open a bank account in Hong Kong or Dubai and keep. Now, if interest is coming out from India to Singapore, but it's being paid into a Hong Kong or a Dubai bank account, the treaty says that you can't claim the beneficial tax rates because the income is not being remitted to Singapore. So the interplay of beneficial ownership versus remittance of money. Now, in the context of beneficial ownership, I may still be the beneficial owner because I have control on a bank account which is maintained by me in Hong Kong or Dubai. But India will not allow you the lower tax rates because they're saying that the income is not coming into Singapore. So I'll leave it for further thoughts or discussion.
Thank you, Rohan sir and Hitesh sir, Uday sir, to give us light on this beneficial owner concept. One thing that we've received from the audience was on the point that Rohan sir pointed out on the back-to-back transfer that happened between Singapore and Mauritius is about the timing difference. If there is a timing difference that the same amount has been remitted after 2 years or 1 year or 3 years, how do you think, what would be the substance requirement at that time?
I think interesting question. I really don't have an answer to that to say that if it's remitted after 3 years or 4 years, because, unless there is a mechanism for tracking the income that comes in and the income that goes out, and can you track it, then if that tracking mechanism is possible, then yes, we run the same risk. That's one. Secondly, I think what is also important is the disclosure in the financial statements. Very often we ignore what the financial statements carry because when you look at the notes to accounts or when you look at any transaction that happens between related parties, some of the notes to accounts are extremely important because they describe the transaction and they describe whether there is a payable back-to-back arrangement or a payable that is there from the Mauritius to the at a higher level to its parent or another related party. And if those financial statements carry such notes, at least in Singapore, the tax authorities will pick that up and say, this is note that is saying that you are not the beneficial owner because you have to make a back-to-back payment. Now, whether that payment happens in the same year or perhaps could happen 2 years down the road or 3 years down the road, as long as it is recording a liability for that payment, I think you'll get stuck.
May I just come in here? I think equally an onus lies on the company to prove, let's say if they've remitted it outside of Mauritius, let's say after 3 years, there is equally a responsibility on the Mauritius company to prove that what it was doing with the money that it had received. So it's not as simple as just saying that I held it for 3 years in my bank account and I remitted out. And this often happens in the context of investment holding companies. So for example, is the investment holding company in a position to demonstrate that I look for more investment opportunities of the money which I am the owner, but could not find any? And these are minutes of my board meetings, which shows that I had discussed these investments to be made, etc. And then after due analysis, this was found not investment worthy by us. And therefore, after 3 years, we said the best use of money is to return it to our shareholders. Now, if that can be proved also, rather than just holding on to the money for a period of time and saying, okay, I'll remit it out next financial year, I don't think you are crossing the hurdle of actually proving beneficial ownership if you are challenged. So I think equally, there are two ways of looking at it. Yes, the negativity is, negative view is that if you just blindly remit it out without anything, certainly you will still be caught in the mischief. It doesn't matter what the time period will be. But more proactively, I think you should be able to demonstrate that as a beneficial owner of that particular income and then that asset in the form of your bank account, what decisions did you take given that your business was an investment holding company, to find out other areas of investment, etc. Even it could be that, maybe the money was not just lying in the bank account, but let's say you put it in a money market or a treasury mutual fund to say, okay, while the money is idle, we will do this till we find opportunity. So that proactivity also must be shown by the Mauritius investors. And if unfortunately those facts don't support, it's a pure back-to-back, then I agree with Rohan that you can't just get away merely on a timing difference.
So it is just, let me give you a parallel to assuming this was India. Clearly, the back-to-back will fall under that deemed international transaction because of the transfer pricing regulations. And I'm sure there are similar regulations both in Singapore and Mauritius, maybe at a different level compared to India as a far advanced transfer pricing. Just because you brought an entity in between, what did Mauritius, what is the role of Mauritius? Transfer pricing will straight away hit you. So there would be the payment from Singapore will be questioned, assuming it was India. I'm just saying that. A deemed international transaction, and then that would be questioned. And a pure conduit or a shell company, as although it is in the context of capital gains, but equal, this thing will apply, as you rightly said, about international holding company. BEPS and entire BEPS program will be applicable. And I'm just giving a parallel to India. And I'm sure Singapore and Mauritius will have an equal applicability there also.
So just one thing, I'm not sure whether transfer pricing will actually apply to a dividend flow.
No, in the context of royalty. I think I understood royalty, maybe.
Okay, I understood that, dividend. But royalty, yes, you could be caught if India has remitted out royalty, and then it's as the consequence of a transfer of immovable property for a usage or whatever. Yeah. But your dividend may not be covered by the transfer pricing.
Dividend will not be covered. I agree.
Great. So talking about dividends, we have seen that how mischievous is the India-Singapore double tax avoidance agreement over here. So I would request Uday sir and Rohan sir to comment a little bit about the Article 10 of the treaty in light of the domestic laws, both in India and Singapore, and also a little bit about the foreign tax credit.
Ron, you want to go?
Uday, you want to go first? Because it's income coming
can.
Out from India to Singapore, which is okay.
Yeah, I agree with you. So interestingly, the dividend article 10 is like any other article mostly found in most of the treaties, except that the withholding tax is reduced to 10% instead of a 20% under the domestic law, or most treaties are 15%. Except that it says that and then naturally we discussed enough about beneficial owner. So we assume that the Singapore company which has invested in India is a beneficial owner. The rate will be 10%, provided it owns at least 25% of the shares of the company paying the dividends, right? And in that situation, no problem, a 10% instead of a 20%. Like any other treaties, the treaty puts a ceiling here. The wording uses the tax so charged shall not exceed the total amount. So the question which has come up in most of the treaties is whether the 10% should be the tax or 10% plus surcharge and cess. And there are enough rulings which support that it is the treaty which is putting a ceiling on the total tax amount. It's not the tax rate, but the tax absolute amount. So that the withholding tax would be 10% without surcharge. Now, interestingly, what they have put in, and if I understood, is that beneficial owner is a company. That's the wording used for the purpose of 10%. Now, under the FDI regime or NDI rules now, foreign investment, you can invest as either an individual, or you can invest as a company, or you can invest as LLP or a partnership. So the way I read the treaty, the 10% rate will apply. Of course, the distributing entity is a company, but the recipient also should be a company, because the 10% of the gross amount of dividend If the beneficial owner is a company, it means it should be a Singapore company. So if Singapore partnership has invested or a Singapore individual has invested, the 10% rate should not apply. It will go back to 15% as it is said here. In all other cases, 15%. So it's important to keep this in mind from a withholding tax perspective. Of course, after the DTAA has gone, otherwise it was not relevant. And if the dividend is not taxed, the question of the tax credit, I think you can answer it from I can answer it from a India outbound perspective. But whether then there will be a tax credit or not if dividend doesn't, as I understood, there is no tax on dividend in Singapore on a foreign dividend, if I understood correctly. Let me just stop here on this. So the key points are the company, the Singapore company will get a 10% rate. Any other entity will be 15, still compared to a 20, or an individual even may have a higher rate under the domestic law. Yes.
So from a Singapore standpoint, dividends are not taxable, right? So essentially it becomes a cost for the Singapore company because you can't claim a tax credit on income which is not taxable in Singapore. So to that extent, whether you can claim foreign tax credits or not is out of question. So it makes it a little bit more easy or difficult, as the case may be. Uday raised a valid point in the context of distributions by partnerships. So whilst, or receipt of income by a partnership, there could be a Singapore LLP which is just receiving dividends, which is fine. But let me put a different question or an issue from a Singapore outbound, right? So a Singapore LLP or a Singapore company invests into an LLP in India and is a partner in an LLP in India, right? In which case, under the Singapore law, there are only 3 specific exemptions which are given in respect of remittances of funds that come back into Singapore. One is dividends, one is service income, and one is a branch profit. Now, when I invest into an LLP and I get a distribution of profit from the LLP, because the LLP is not declaring dividends, right? It's a distribution of profit that comes back. So that distribution of profit, on the face of it, is taxable in Singapore because it's not covered under any specific exemption. So unless I can keep the profit offshore and you use it or utilize it for other purposes, which could be, for making more investments or for lending onwards, but I get stuck at a Singapore level. So that's point number 1, that can become taxable. The second question then comes out is, how do I then claim tax credits in Singapore? Because at least in the Indian context, I think the LLP is taxable as an entity, right? Now, let's look at a quirk and add on a little bit more complexity. Let's say if I have an LLP, which is investing into an LLP in India. So from a Singapore perspective, an LLP is a pass-through entity. It's not taxable. So you can't get a tax residency certificate for an LLP. It has to be based on the partner's individual tax status. How will this work in the Indian context? Because then there's distribution of profit, there's tax credits, who should claim the tax credit, whether the partner should claim the tax credits. So it opens up a whole sort of Pandora's box in terms of taxability and tax issues that come out. But, suffice to say, from a dividend perspective, I think it's fairly simple and easy at a Singapore level.
So interestingly, on the LLP that you made, when you always look at India, you look at the LLP versus company and the base rate of 25 versus 35, but distribution is tax-free. We have seen this in the context of US. Okay. The distribution of profit at India level is tax-free, as you likely said. It is taxable in the US on a current basis. Forget the repatriation. And so that becomes the LLP investment in India. The investing entity, no problem. But in India becomes very inefficient from in this situation, Singapore or even a US perspective. It's taxed on a current basis.
If I may come in, especially on the context of LLP and its partners, I just want to draw attention to a couple of cases which are in the taxpayers' favor. I think those treaties were, to the best of my knowledge, UK and the Denmark Treaty, and also the Netherlands Treaty, if I recall. So the most famous case which started it all, and they might remember, so the early days of our Big Four career, was the Linklaters LLP decision, where a P was alleged, and of course whether partners were taxable, the company was taxable, who was taxable, etc. Whether if they were taxable, would the benefit of the treaty for all non-business income could be given, etc. Then there is the AP Moller case for as far as Denmark is concerned. And then there is a ING Bevar Masterpitch BV case for Netherlands. Now, in this case, in all the three judgments, you will find that there are arguments to support the view that treaty benefits should be available to fiscally transparent entities, even in the absence of a specific provision as such in a tax treaty. And while there are definitely chances of litigation, and considering that the language of the treaties of, let's say, UK, Netherlands, and Denmark are not 100% the same as the language of the treaty so far as Singapore is concerned. And again, there is a noted position that India and Singapore both, if you see the OECD, model commentary, both India and Singapore have expressed a reservation to grant the benefits of the treaty to transparent entities. So that makes the task even more difficult because the revenue has made its position known from the beginning. So that precludes any planning as such. But if you are caught in a difficult situation, to my mind, you will find enough material on first principles from these three judgments, which are very well-reasoned judgments, to make out a case that the treaty benefits ought to be applied.
You are right. The reverse, assuming you were to take a reverse scenario, Indian LLP investing into Singapore, Indian LLP is clearly a taxable entity. So like the term person under Article 3J, person includes individual or any other entity which is treated as a taxable unit.
Correct.
So I would believe the reverse scenario, clearly you should be able to claim that.
Reverse scenario, there is no problem. I'm talking of a case in an inbound situation where you have, let's say, a transparent entity coming into India, and then what happens to the taxability, whether you give the benefit of the treaty or you don't.
Yeah.
This rightly covers about the residency and the availability of treaty benefits for transparent entities like partnerships. So, I mean, during our previous discussion, Hitesh sir, you mentioned about the importing the term beneficial ownership in Article 13 of the DTAA. Can you elaborate a little bit on that for us, please?
In the context of capital gains, more specifically, because I've already expanded on the entire concept of beneficial ownership generally. So I presume we are looking at now Article 13, capital gains, and whether it can be actually imported into that. Now, as I said, the Mumbai ITAT, this case is, of course, a reported judgment. This is Blackstone's case. And interestingly, the learned member on the bench was Mr. Pramod Kumar. No surprises there. Because he refused to just accept the tax residency certificate at face value. He actually challenged factors beyond just the tax certificate, which weighed.
Sorry, sir, to interrupt, but I think the last part you were not audible. Can you go on?
Where did you be?
After the Blackstone judgment, you were telling about non-acceptance of the TRC.
Correct. So, in Blackstone's judgment of the Mumbai tribunal, where the learned member, Shri Pramod Kumar, actually was the member who was on the bench, he actually challenged the AO. First of all, he said, proving or non-proving of the lack of beneficial ownership is a burden of proof which rests primarily on the tax department. So therefore, it's the tax department's duty to actually demonstrate that there is no beneficial ownership. And the AO had actually failed in looking at or ascribing even a single reason He had in fact just overlooked the tax treaty and just said that this is a shell or a conduit company and it is a company without substance. These were just bald remarks that it had in the assessment order. And therefore, this issue of whether or not circular number 789 was paramount to stop all further discussions. Now this judgment at least leaves that question still open. So this judgment did not actually dwell too much on the merits of the applicability of circular number 789, but it actually remitted this matter back to the assessing officer to determine independently as to whether there could be circumstances which would demonstrate that there is a lack of a beneficial ownership so far as the taxpayer was concerned. And to my mind, it relied, on certain Supreme Court judgments of European nations. So, first judgment is one of Czechoslovakia Supreme Court. The second is of Bulgarian Supreme Court. Third is of the French Supreme Court. And the fourth is of the Swiss Supreme Court. In all these cases, and I don't want to give you the citations right now, but you can, Google beneficial ownership in the context of these four countries and these decisions pop up right away. In all these four countries, the judges came to a conclusion that despite the concept of beneficial ownership not being specifically embedded in the capital gains article, the revenue was not precluded from getting into the question of the eligibility to claim the benefit of the treaty in the first instance. So at inception, if you did not be eligible to get in, maybe because you were not the beneficial owner of that particular income, then according to those four Supreme Courts, it was not necessary to get into the beneficial ownership not being there in just the capital gains article. That to them was a minor issue as compared to this fundamental issue of whether you could access the treaty in the first instance at all. I think therefore the last word, if you ask me today, has not been said on this matter, even in the context of Mauritius, forget every other treaty. And therefore we live in interesting times. We'll see further developments as the cases are reassessed and brought back into litigation.
I think Uday sir, do you have a comment?
No, not in the context of beneficial owner, but I think when we looked at dividend, we looked at the Singapore outbound, India inbound. Let me just take less than a minute on India outbound, Singapore inbound. So we are also seeing a lot of Indian companies flipping the structure or genuine investment out of Singapore. So when I looked at the similar situation, same company and whatever 10% rate, 15% rate, there is no withholding tax on dividend as I understood from Rohan. But when it comes interestingly to foreign tax credit, Article 25 of the treaty and has not only a direct tax credit, which is not applicable because there is no withholding tax in Singapore, but there is an underlying tax credit. Also, there is a tax sparing. So we look at most of the Indian treaties that I have seen, the underlying tax credit is a one-way traffic. Most of the time, it will be in the other country. It's only in Singapore and Mauritius where the underlying credit is a two-way traffic. So if Singapore company pays dividend, then not only the direct tax, which is nil, but the tax which has suffered at Singapore level can be claimed as an underlying credit as a foreign tax credit. That's one. Second, there is also some number of provisions, and Rohan, you may be able to see this, number of provisions of Singapore tax law, which are assuming Indian company invest in those projects, like right from section 13 to 43 and everything. Like we had section 10.4 or ATIA and all those sections. Similar provisions if there was a taxpayer. So India-Singapore treaty gives all three credits. The direct tax credit, which is nil here, underlying credit, also the tax-paying credit. Now I went a little further and I said, let me see whether the Form 67, which talks of the tax credit, does it support at all? I don't think that would have been thought through. But fortunate, and there is no specific mention, of course, of the underlying credit or a tax sparing. But when you look at Form 67, finally, that's the form which will give you a credit, all said and done. When you read with Rule 128, which is prescribe all foreign tax rate rules, I think it is possible to, even put in those numbers, having said that everything online, right? There's also self-certification possible, or you can obtain those tax certificate from Singapore authorities, or the taxpayer himself can sign and give you documents. So interestingly, although there may not be a withholding tax, Rohan, I think the tax underlying credit for whatever tax paid in Singapore should be available. And if at all we qualify for tax sparing, then tax sparing should be available. But certainly underlying credit is one area which should be possible in my view.
That's true. I mean, underlying tax credit should be possible in Singapore. If you're looking at it from a Singapore perspective, right? Which means Singapore is the holding company and therefore making the investment into India, and therefore the Indian company is paying the tax for the corporate tax, and you want to claim an underlying tax credit in Singapore.
No,
is that your situation?
No, I was saying reverse.
Okay.
Because the Indian company is invested in Singapore,
right,
and is receiving dividend on which there is no withholding, as you rightly said, but it has already paid corporate tax in Singapore. Correct. When you look at the tax credit, foreign tax credit provisions in India, direct credit will be zero, but underlying
tax credit should be
available in India, because in India dividend is now fully taxable, right? At 25%. I'm just leaving ATM and other thing for the time being.
Yeah,
but fully that should be possible.
Correct, should be possible. The only challenge that I had another complexity into it is that what happens. It should be possible if the accounting years of the Singapore company and the Indian company are the same. If for example, Singapore closes on 31st December and India closes on 31st March, then the ability to claim that tax credit might become a little bit more challenging and complex.
But Rule 28 addresses that situation. A proportionate credit is available depending on how. Okay. It also talks of 2 different years and everything.
Right. All right. Okay.
Now that we've talked about the dividends article, the capital gains and the foreign tax credit, so what's left here is the fee for technical services and the hype about the make available clause. So Uday sir, please, your comments or your thoughts on this.
So interestingly, if I recollect correctly, Hitesh, maybe the make available came for the first time in India-US treaty. That was after 30 years of negotiations with the US.
In the technical commentary.
In protocol, right? The problem of course, in the US also was the tax sparing clause. India never agreed on that. Sorry, US never agreed on that. But when we looked at this make available clause, technical services under Section 9(1), clearly all managerial, technical or consultancy services, very clearly taxable in India. Let's assume there is no pure technical services. But the India-US treaty for the first time made this comment. And after that, number of treaties have got renegotiated or amended. Singapore is one of them. To say that the wordings are a little different, but I think the answer is same. Then there are in the US treaty, they say that the technology is made available when you are the acquirer of the technology is enabled to use it and don't need the transferer. So you should be able to. And this particular concept has been implemented in most of the tax judgments which have happened after that. So what it says is that somebody came and simply rendered technical services, or it transferred the technology, but the acquirer did not know what to do with that, and he still had to rely on the same person if at all there was a need next time. That is, technology is not made available. There are judgments, tribunal judgments in the context of India-Singapore treaty. Of course, there is India-US, India-UK also. But since we are talking of Singapore, let me just read one particular judgment which I found it interesting. This is the Bangalore ITED judgment in the case of Filtrex Technologies Private Limited versus Assistant CIT. And interestingly, the company had 2 kinds of agreements. One was a technology agreement, and second was a managerial services agreement. They were providing certain, the first situation, the technology was provided and the tribunal came to a conclusion based on the facts and circumstances that the technology was made available, and hence it was taxable as royalty or fees for technical services. The second situation was very interesting. Same company, the agreement was to provide services relating to these interesting public relations activities, liaison, coordination and design of advertising materials such as PowerPoint presentation materials and leaflets, etc. And the tax officer first held that this is managerial services, and based on the facts, it held that although they were management services, the same was made available, and SSC did not. It actually meant that the technology was made available, and in the second agreement, it was held to be taxable. Now, the Singapore Treaty is loosely worded. It has all the three words: managerial, technical, and consulting, and then talks of made available. If you look at the India-US Treaty, to best of my memory, the word managerial services is absent. This is technical or consulting in nature. So if there were managerial services being provided by a US company to India, no need to get into make available, straight away exempt. Here, the clearly management services like the 917 definition was there, but still tribunal came to a conclusion that in this situation, the services were being made available to the Indian entity, and hence it was taxable. Similar judgments, but the essence part of it is it should be the enabler of the technology should be able to use it, and he gets the further knowledge out of it. And we always talk of this one part, make available, but I have seen in the context of large EPC contracts, there are two concepts there. A pure service will be like this, but I think we forget in that, and I thought I will put that part also. If I look at the same wording here in Article 12, I'm reading the clause B, which said make available technical knowledge, experience, skill, know-how, or processes. Okay, or it consists of development and transfer of a technical plan or technical design. Number of EPC projects, we forget this part. Maybe they come here and construct a power plant or a refinery. You're not making available any knowledge, experience. But as a part of that, a lot of designing is done. Those plans are being exchanged. So although you may get out of the make available, you may get caught in the consist of a development of a technical plan or technical design, particularly in the context of large infrastructure projects. I just thought, although we said make available, that second phrase is very important.
If I may just add, I've always understood, and maybe this can benefit participants, so I'm just bringing it out. I've always understood the make available clause very simply. To say, okay, what is fees for technical services? It is payment for know-how. What is make available? It is payment for show-how of the know-how. So wherever there is make available, there should be payment for both, not only the know-how, then it is still not technical services. Payment for the show-how of the know-how make available.
Yes, true.
So let me give you a Singapore angle to this, right? So when and this is a very on a practical basis. So Singapore typically, if they are providing services, let's say technical services or going under this make available clause, and we say that we are not making available, let's say it's held that you're not making available. But on a practical basis, what happens is that when you have a customer in India who's making a payment to a Singapore company, they will withhold tax under the treaty, saying that this is, under fees for technical services. I'm not going to get into any sort of make available discussion because I am the payer. You go fight it out. The Singapore company then receives a payment after taxes have been withheld. The Singapore authorities are smart. They are now saying that, sorry, this is under the treaty. You're not making available anything. Therefore, your client has, or the customer has wrongly withheld the tax. This is actually now Singapore sourced income, and I'm not going to give you any credit for the tax that you have incurred in India. Therefore, and hence, you want to fight, you go fight in India, go to the Indian authorities and say that this is not covered and claim a refund for taxes. Most companies in Singapore will be shy of filing a tax return in India because they believe that the moment you file a tax return in India, you can get exposed to multiple issues. So on a very practical basis, this is the biggest issue which Singapore companies face when taxes get withheld on a practical basis, because payers don't want to really take the position of make available, and they say that you go fight it out.
Similar with US, very clearly, Rohan, the FTC rules in the US don't provide. They say that's a Indian, Indian issue. Go and file the return and claim the refund. So, no. Just one more point. Sorry, are you done or you had other comments?
No, nothing. No.
I just have one more point. Assuming it was make available, there is an Article 12.5, which is there again in the other treaties also. Notwithstanding paragraph 4, fees for technical services does not include payment. Then there are specific kind of situations which are mentioned, and two aspects become more practically relevant. I have seen in many situations. Assuming there was a teaching institution, some university which was providing. So it says for teaching in or by educational institutions is not make available, even though it is fees for technical services as for ABC. If you have done it for teaching, and I've seen it practically by a university from US, which will again be applicable here for US, or for Singapore also, or interestingly for services, this is clause C, 12.5C, 12.5D for services for the personal use of the individual or the individuals making the payment. So in these two clauses, we have seen that although it was a make available clause or a development of technical part of FTS in general, if you have gone through this, particularly for the education, and now why I'm saying is number of foreign educational institutions universities are coming to India, of course in the gift city, but even we've seen the online courses in last 2 or 3 years in the pandemic. We had a situation where a US university is teaching a full-fledged 2-year MBA program online, full-fledged. So if that's a situation, maybe you could claim exemption under this 12.5 C or D.
If I may just add one more thing, in the context of make available, it is extremely tempting to hold out India, UK, Singapore as having the make available clause, and therefore, sort of trying to get away from the withholding tax so far as the technical services is concerned, or fees for technical services is concerned. But in those treaties, you have to watch out for service fee, because inevitably where there is make available, I have seen that the permanent establishment definition is actually expanded to include not only service fee, but a very limited threshold so far as related parties are concerned.
Correct.
I think for US, there is no threshold at all. Even 1 day service can result in a service fee. I think Singapore is...
Same year. No, same year. Yeah. Same year, Hitesh. Even related party 1 day is a fee.
I think
30 days. 30 days.
Singapore is 30 days.
I think so.
Singapore is 30 days to the best of my memory.
Okay.
So one has to be careful that while one is tempted to get away from paying the withholding tax due to the make available, one should not unfortunately get caught into the service fee conundrum, because then you are in a kind of a worse situation, because you don't know then what is the exact amount that will be alleged to be taxed. You will most likely not get any deduction for any expenses because you're not withheld tax, etc. for Indian regulations, and therefore your 40A disallowances all will kick in. So I just thought in the context when we are discussing so much about make available, be also cautious of this service fee exposure.
Very valid point.
Very valid point. In fact, you have 44 DA also under the Income Tax Act, right? Exactly like that. But a treaty, I stand corrected, is 30 days here in Singapore. Correct.
This was an interesting observation, and I think that's typically US being US, introducing new concepts, creating controversies across the globe by giving out make available and then compromising on the service fee part. I think the next topic we can talk about is that the DTA has a specific provision, that a specific anti-avoidance rule for the financial expenses, and also the GAR is applicable. So how do SAR and GAR coexist? And then I request Uday sir and Hitesh sir to give out their opinion on this, please.
Uday, you want to go ahead?
Whatever.
Okay, so let me start then. So yes, interesting, this interplay between, let's say, the principal purpose test and the GAR, and specifically principal purpose test being more stringent, whether this would override the provisions of the treaty. Now, if you ask me, Article 25.2 of the Singapore Treaty, 25.2 was on the underlying credit. My apologies.
Yeah.
So, circular I would draw attention to of 7 of 2017.
Yeah.
And question 1 asked in that circular is whether GAR and SAR can actually coexist. And this actually has been answered in the affirmative. And we can draw some support on the interplay between PPT and GAR. That's why I referred to that conversation in the first instance. In the context of PPT and GAR, one sees that, the PPT under MLI, the principal purpose test, is considered to be a stringent rule and far wider in its ambit. It can be invoked in a case where obtaining a benefit under the treaty would be just one of the principal purposes, whereas GAR is triggered only if the main purpose of the arrangement is to obtain a tax benefit. Also, unlike GAR, no requisite safeguards or approval are necessary, before the tax authorities can allege this. So therefore, to my mind, this situation is clearly risky from a taxpayer's perspective. Merely because you are technically, let's say, meeting a specific anti-avoidance rule. So, for example, let's look at the protocol and you see that you are meeting this $200,000 test. But can GAR also be invoked? Can, let's say, MLI be invoked, if at all? To my mind, merely because there is a specific provision so far as anti-abuse is concerned, it does not preclude the authorities from alleging that we are going to apply GAR or the provisions of MLI. Uday, over to you.
So I agree with you, Hitesh. Both can coexist. In fact, FAQ on GAR makes it very clear that SAR and GAR can coexist. Also, if you look at section 95, which talks of GAR, right? GAR applies to both domestic and international transaction. Now let's focus only on international transaction. It starts with a non-obstance clause, which says that notwithstanding anything contained in the Act, section 95(1). Now this question had come up in the context of MAT also, right? Or the treaty, whether 90 subsection 2 or 95, which comes first? To me, it looks like treaty will be overridden. If the GAR is applicable, clearly treaty is overridden. If the GAR is applicable, then the SAR does not make sense, right? SAR is only under the treaty, restricted. And so very clearly, according to me, the legal position also is very clear that the SAR is applicable does not mean you cannot question under GAR, just because of the non-obstance clause. And if then the authority come to a conclusion that GAR is applicable, then treaty is not applicable. So the SAR has no meaning.
Sir, some comments on also that how it affects the investors both in India and Singapore because of the overlap of the PPT and GAR.
So if you ask me, to my mind, the world is increasingly moving towards a situation where artificial structures will be challenged and will be successfully challenged. Interposing merely conduit companies in jurisdictions which have favorable treaties among trading partners, etc., I think is a thing of the past. Especially at the planning stage, I think a lot more care is being given by, professionals to emphasize the situation of substance in not only the purpose of for which the entity is formed, but also in terms of who are the key managerial personnel who will be driving those business operations, that there is a business reason. And it's not as if one of the principal purposes is also a tax avoidance. And many a times now, once these provisions are actually highlighted by, for far-thinking professionals, many companies now are thinking twice before just putting down, subsidiaries in every jurisdiction, which may give some sort of a tax benefit to them. I think that's my overall conclusion, that, be it your GAR provisions, SAR provisions, your treaty loopholes being plugged, your pillar 1, pillar 2 coming in, tax transparency being highlighted as one of the features of every economy which one should aspire for. I think we have moved a long way, and one should clearly, therefore, go back to the first principles of substance. Unless that is there, I don't think these planning opportunities will survive, and certainly not the test of judicial scrutiny.
So if I may add to what Hitesh said, I think it's absolutely correct. And increasingly, what the trends that we are seeing, and I'm maybe diverting it a little bit from the India-Singapore discussion, but from a Singapore and a Asia Pac, or if you're seeing on a globe, at least in larger countries in the Asia Pacific world, the tax regulators are asking for advice given by the tax professionals. And they are calling for that advice to see whether this was given as a part of tax planning and whether any advice was provided with a view to only plan without there being commercial substance in it. So not only that makes advisors more sort of rigorous in their views and positions that they take. That's one. Secondly, I think advisors themselves have moved away. Nobody nowadays advises a BVI or a Cayman structure, because they've just moved away from everything like that. And given the fact that there's Pillar 2 that's coming in, and the CBCR is already there, there is a lot more sharing of information. And we've seen instances multiple times when the Indian tax authorities have actually reached out to the IRS and asked for clarifications. And IRS has then, because it relates to our clients or companies here, have reached out to us saying, can you provide clarification? So it's not that the regulators don't talk. The regulators themselves are also communicating and asking questions. So that, as Hitesh said, the world has changed and we are living in a very different world from what we were 30 years back.
May I just draw attention to another practical experience we recently faced, okay? This was a US giant, okay, with a very substantial operations also in Singapore. But while it ticked the right boxes so far as GAR, SAR, all those situations, even MLI was concerned, unfortunately, under India's regulatory environment, the regulator did not grant the appropriate license because a large part of the intermediate structure between US and Singapore consisted of Cayman. And why Cayman was under the limelight? Because it is now one of the countries in the grey list of FATF non-compliance. Now, we have been stuck with this application at the regulator level. And every 6 months, we are told that Cayman is going to go out of that list, go out of the list. And we have been told that when we can, after it is gone out of that list, we can present the application. But believe me, it is called untold misery to the clients, wherein substance, they have nothing to hide. It's just that in a fund structure, the business that they are carrying on globally consists of financing by a large portion of external investors, if you will. And this is a pooling vehicle which is sitting in Cayman. Now, regrettably, the regulator has chosen to go strictly by the letter of the law and not grant the approval. So this is another non-tax angle I'm bringing out, that where you could get stuck despite your best intentions to make sure that you don't cross any borders so far as MLI or PPT or GAR or SAR is concerned.
Sir, a short note on, I mean, when you've talked about these investment structures and PPT being there in the treaties now with the MLI in force. So what could be like the suitable documentation, or how to actually prove that the principal purpose of the transaction or the structure per se was not tax benefit?
So if you ask me that question, I always go first on the business. Even though I am a tax practicing professional for the last 38 years, I believe tax should never be the driver of business. If one focuses on the business and one understands the rationale for why a particular structure is being put up, or why or how a particular business is being conducted, then I think the question about documentation, etc., becomes secondary, because the business itself will throw out enough substance for you to just document. And in this very same example, let me bring out that it was US and Singapore, and the business rationale came through very clearly why Singapore was involved, what was the role they were playing, overseeing, let's say, India for such a long time. Now only it had to be formalized in the form of a structure, because there were very big plans to grow that business in India. And Singapore employees were considerably beefed up for their next 3-year plan to actually exponentially grow the business in India. All that was very easy to document. I think the failure is that we jump to saying, okay, if I have sufficient documentation, I have cleared substance. No. I think we are putting the cart before the horse. Some advisors I know have just simply said, you hold 4 meetings outside and let everybody fly down to that location, and there your substance is met. You just show the board minutes. And in such a situation, when I was challenged and this client we were defending, unfortunately, much later, 6 years minutes, 24 minutes were identical. Not a comma or a full stop had changed. Now, how do I defend that to say, yes, minutes were held? Board meetings were held. Identical. It is as if somebody took a photocopy, just changed the top date, and here were the minutes, 24 of them, but useless.
And that would have been written 24 days before, after the, whatever notice came. So you're right. Those countries don't care, right? In those scenarios, number of companies, there's board meeting, no nothing, but you just did cyclist. Yeah, those things are not going to work at all.
Actually surprised me from a Singapore angle also, the authorities, really coming down hard on substance requirement. Actually, this seems to be a recent development, perhaps the last 3 or 4 years, because, prior to that, regularly when we used to visit Singapore, I mean, many advisors were a little casual about that, to say, yes, but we can show an office, we can show a company secretary, there'll be professionals who will look after as directors. But I think if Singapore is also showing some spine and bringing in real substance at a implementable level, then I think the world has really changed.
No, that's true. You're right. In the last 3-4 years, they've really become quite aggressive. In fact, for one of my clients, they interviewed the board members. They actually physically interviewed them, saying, what role do you play? What do you do? And explain your function, etc. And so they get to that level of detail nowadays. So it's not, gone are the days where you could, like you said, have 4 board meetings and, photocopy them for the last 6 years. It's all gone now.
Well, the treaty uses the word shell or conduit company. I mean, I have not seen in many treaties like this, right? So it does talk that you don't want to be part of that shell or conduit, right? You want to be a genuine, regulated, Those questions did come up, right? For if not Mauritius, okay, let's go to Singapore. No more now. So I think each country wants to be away from that.
And at one time, I know that we had a person from the Indian Tax Authority sitting in Singapore. He was sitting along with the part of the High Com, and looking at transactions.
Yep.
This is very interesting to know, and like we've discussed a lot of nuances of the double tax agreement, covering the concepts of the foreign tax credit, income allocation rules, residence, and the MLI we've touched upon a little bit. Let's go on talking about the elephant in the room, that's Pillar 2. So I would request Rohan sir to give us a little background on the Pillar 2 and how do you see Singapore tackling Pillar 2 and the global minimum tax of 15% and its potential implications, I would say, over here for the businesses.
Right. So Pillar 2 is sort of a concept which is now being rolled out on trying to make it a more global thing. Simple comment without getting into too much of technicalities and details is that essentially they want to introduce a minimum tax rate globally. And I think yesterday or this morning I read that global tax rate is now agreed upon at 15%, right? Anyone or any country which has a lower than 15% tax rate, then the entity which is benefiting of that would either pay that tax, the additional top-up tax rate in its home country or in the country in which it is incorporated or a resident of. So in a Singapore context, let me explain. Let's say you have an entity which has a tax incentive of 5%. So let's say it's a simple trading company. It's got a tax incentive of 5%. The Singapore actual corporate tax rate is 17%. Now, under the Pillar 2 mechanism, and let's say this company is a UK company, right? So UK company having operations in Singapore has an incentive of a tax rate of 5%. Now, absent Singapore trying to introduce a minimum effective tax rate of 15%, the entity in Singapore, which is the subsidiary of the UK entity, will end up paying an additional top-up tax in UK in respect of the income which it has in Singapore. So UK will have that right, which is what the Pillar 2 says, that the home country or the ultimate parent entity will have the right. Unless Singapore now comes back and introduces a minimum domestic tax rate of 15%, which is applicable to companies which have incentives like this company, which gets taxed at 5%. In which case, the company which has an incentive in Singapore will end up paying a minimum tax of 15% in Singapore. And that's what essence of Pillar 2 is, because each country will then come back and say, I am not going to let someone else take the tax from the table, right? This country is operating this company is operating in my country. I should have the right to decide how much to tax and not to tax. And therefore, I will tax 15% rather than give that income or money away to UK to come and tax it. So that is, in a sense, Pillar 2. Now, there are multiple nuances. There are rules that are there, which is called the income inclusion rule, the underpayment tax rule, etc. So Singapore, it will introduce the income inclusion rule. As I said, Singapore also has a territorial basis of taxation, which means offshore income is not taxed, right? So now, by virtue of an income inclusion rule, it might also mean that there are certain offshore income which gets included into the taxable income of this company. That's one. Secondly, Singapore doesn't also have capital gains tax. What happens to capital gains tax for companies which are eligible for an incentive or an incentivized tax rate? How do they operate? So those are the nuances which still need to be addressed. From an overall perspective, Singapore, in its budget of 2022, did make a statement, the finance minister did make a statement that Singapore will introduce the domestic minimum tax rate. They stopped short of saying when it's going to be introduced. There are speculations that it will come in next year. We don't know that as of now. Now, if you look at the entire makeup of Pillar 2, from what I last hear, I think US is still not on board and has not yet fully accepted Pillar 2. From a Europe perspective, I think there are a handful of European countries which have accepted or willing to implement Pillar 2 from 2024. It is not the entire EU that has accepted it, but there are a handful of those countries. So from a Singapore standpoint, it is not in Singapore's interest to be the first mover, because we still have incentives in Singapore, and we are encouraging companies to come here and operate from here, set up operations, and we are willing to give tax incentives. So it's from a Singapore selfish perspective, it is not in our interest to be the first mover. Having said that, we are aligned to introducing Pillar 2, and the effective minimum tax rate is just a matter of when and which countries come on board, so that collectively, and if we see a larger number of countries on board, then we will definitely introduce it. We do believe that that it might come in next year. The tax authorities, the regulators, the Economic Development Board, and everyone else have been having closed-door consultations with various groups and industry groups and associations to take into account what their concerns are, what their issues could be. But we will see Pillar 2 coming in sooner rather than later. First there was whether 2024, 2025, etc. Before I conclude, just one important point that is there is that when we look at Pillar 2 being introduced and we look at it from a pure tax implementation or tax perspective, I think the key, and that which is extremely important to note, is from a provisioning perspective. Because the moment Pillar 2 kicks in, let's say Pillar 2 kicks in from 2024, that means when you close your financial statements of 2023, you'll have to make provisions for that. And when you look at provisions, the accounting guidelines and the accounting treatment of certain transactions, whether they relate to deferred taxes, whether they relate to restructuring, that is still a little bit in a gray area. So I'll let Uday and Hitesh also comment from their perspective. Any thoughts, any views?
So interestingly, Rohan and everyone, Pillar 2 was not part of the original BEPS program. If you look at Action 1, which started in 2016, 17, and 18, we had the interim report. It was talking of taxation of digital economy, mainly yes, for a country like India, developing countries where you have all these Googles, and we have now significant economic presence, but a treaty does not support it today. So the whole purpose was, how do the developing or the markets get the right to tax the income? Correct. It is at that point of time, USA was not part of the BEPS program at all. With the change in the government, which happened about 2 years back, 1.5 years back, when the Democrats came, they jumped into this situation. They said, no, it's not only this, because they're going to give out the tax, right? By market jurisdiction, tax will be levied, say, in India, if Google has some operations or Amazon has operation. Accordingly, the US will give a tax credit. So they say the entire BEPS program at that point of time is not complete unless the global minimum tax is introduced. That's how this Pillar 1 and Pillar 2 came together. Whereas in my view, because of the income inclusion rule, as you rightly said, it's like a CFC being taxed in the home country. The USA gets the right to tax that income. In Pillar 1, they are losing it. So developing countries want to push for Pillar 1. The developed countries want to logically push for Pillar 2. Now there are a lot of political and other angles. And some countries in Europe have said, when you're pushing Pillar 2, say first put Pillar 1. Put both together, implement together. So that's a kind of a tug of war going on right now. But I think it's a matter of time. Pillar 2 will come into the picture. Pillar 1 will come. The question is whether it will be 2024, 25. And there are a whole host of complications. If you look at it, OECD is actually inviting comments on Pillar 1 and Pillar 2 on a continuous basis. Because as you rightly said, Rohan, on Pillar 2, how much tax? Because it is going to be the global accounting profits, which will be the base to start with. Now, which are different of US versus India gap versus Singapore gap. Taxable profit is different from the book profits. There are going to be a lot of issues, but either both come together or nothing comes together. On a lighter note, unless US basis, it will not come in my view.
Which is correct. And US has introduced guilty and all of it, So US
they've already done. You're right. They're fighting for 301 with India and equalization levy and everything else. They're going to introduce. Now they have introduced a book minimum tax of 15%, which is exactly Pillar 2.
Correct.
Exactly Pillar 2. So yeah, I think it will all depend on how. And there's Europe, right, where this fractured. Some countries are using it. So unless all countries come together, you have a problem.
And India has just issued a bold circular uh, in July of 2021, where it is stating that it is in favor of Pillar 1 and Pillar 2. That's all. With no timeline on implementation, with no.
India is the first one to support everything, right? The BEPS. The entire BEPS program has actually been operational because of India, I would say.
But Singapore will get impacted. Singapore will get impacted on Pillar 2 because of the incentive regime that is there.
Indeed, this is a very interesting discussion, and Pillar 2 in itself is a very complex topic over here. But just to add a little, that Europe, EU being the front runner as always, has actually agreed today to they have a unanimous consent to have a directive on Pillar 2 and implement it from 2024. So I really think that the other countries will be pushed somehow to go in for the implementation there. And I know that we can go on with the discussion of India and Singapore all along till for another few hours, but then we have some time constraints. So if it's okay with the panelists, we have a few questions from the audience over here. So I would like to take up those questions. I mean, these are open questions. They have not mentioned which panelists they would like to answer. So I invite all of the three panelists here to give their comments on it. So the first question is a situation. It's mentioned that a Singapore company provides services to an entity in Dubai. Out of the service income, pays about 1/3 of the income to a person in Dubai. So how would it go about the withholding tax for the payment made to Dubai? And how about the foreign tax credit? I mean, it's more about Singapore and Dubai, but if you would like to take it up.
Right. So essentially the question, let me articulate it, is that Singapore company has engaged a Dubai company and a Singapore company is providing services in Dubai. Is that the question?
Yes, essentially.
Okay. And 1/3 of the services are rendered in Dubai, 2/3 of them are rendered in Singapore.
Not exactly. It just mentions that the services are rendered to a Dubai person. However, 1/3 of the income that the Singapore company receives, it pays to another person in Dubai.
Right.
So it talks about the withholding aspect of the payment made.
Okay. So the issue, therefore, is largely from two perspectives. The income so let me address both. The income which the Singapore company receives from the Dubai person essentially should be taxable in Singapore if it's remitted in Singapore, unless Singapore can show that it has created a permanent establishment in Dubai and is taxable in Dubai in respect of that income. Absent that permanent establishment being created, the income will be treated as a Singapore sourced income and taxable in Singapore if it is remitted into Singapore. If that income is kept offshore and not remitted into Singapore or not used to for payment of liabilities of the Singapore entity, then that will not be taxable. That's point number one. Point number two, in respect of the payment which Singapore company makes to the other Dubai person who it engages, if those services are rendered outside of Singapore, then there will be no withholding tax on that. I'm assuming that the questions were in the context of taxability of the income and on respect of payment, the withholding tax aspect. If this is not correct, then let me know. But I'm assuming this, and therefore the answers are based on that.
Yeah, I think it was about that. Another question is for Uday sir, because he mentioned about the underlying tax credit. So, I mean, the audience requires a little more clarification on dividend received by an Indian company from a Singapore company. How does the FTC work in such a scenario?
So, as I understood from Rohan, when the dividend is distributed by a Singapore company, there is no withholding tax in Singapore. So there is no direct tax credit available. The full Indian companies now tax at 25%. Till last year, it was concessional rate of 15% or 17%. And on foreign dividends. Now it's a full tax. And let's just keep the ATM, as I said, for the time being away. So it receives the dividend. It is taxed in India at 25%. There is no withholding tax in Singapore. So there is a zero FTC in India. However, the India-Singapore Treaty provides an underlying tax credit in terms of dividend which has actually suffered the tax. So what essentially said is the Singapore company paid a tax of say 15% out of 100, 15 is paid out of the profit of 100, 15 is paid, 85 is distributed as a dividend. So the 15 which has suffered tax will be available as a credit against 25. Of course, the taxable amount will be 100. So you get a 15 of tax credit. And so the net which will be payable in India would be 10 out of 25. 0 plus 15, not only direct tax, but the underlying credit. And if there was any tax sparing in addition, which I mentioned, assuming the tax incentives were given, and that tax was spared, even that spared tax is available as a credit in a reverse scenario. So let's assume there is no tax sparing, that 0 of direct tax, 15 of the corporate tax on which the dividend suffered the tax will be available, 15 plus 0 out of 25, 15 will be available and 10 will be taxable in India. So the total tax liability remains at total 25. And if this was not the case, which is in most of the treaties, right? Then that 25 will theoretically become 40, except that we will say that 85 is then taxed in India. On 85, there is a 25% tax, which is about 20, 22. So that would have been the total tax. Here, you are paying only total of 25 because you're getting underlying credit. I hope I answered it.
Yeah, thank you, sir, for explaining the underlying tax rate, which is seldom seen in outbound scenarios, at least in India.
Only two treaties that I have seen till now, maybe more. Singapore and Mauritius. And okay. Mauritius is dead now, unless you're using Mauritius for investment into Africa from an outbound perspective.
There's this another question, but it's not per se for the taxation aspect, but more on the economic side. So the question is, how would the FDI by Singapore would help and contribute in generating employment opportunities in India?
If you ask me, this is typically a Europe plus one or a China plus one strategy, and a lot of incentives being given now by the government under the FPI schemes, PLI schemes, to try and encourage manufacturing in India. India is still a foreign source starved nation, and therefore whatever investments can come in the form of either tangible manufacturing units or even India being the global shared service center of the world, if it comes in, certainly employment opportunities will emerge from that. And I'm confident that India has sufficient growth potential. In fact, if I would go so far as saying that this next decade at least is India's decade. And therefore, it's not a question of if, but it's only a question of when that foreign investment will come to India.
Also, the startup space also, right? Hitesh, on a larger basis, maybe a lot of Singapore companies we've seen with few Singapore chambers in the startup space, they are investing in India. So that is also going to generate employment, I'm saying, on a larger basis. Not only large projects, but investment in startups.
I think Kota sir had a comment. I think you were raising your hand, sir.
No. I'll give me a minute. Thanks for bringing my conference.
Okay. So I think with this question, our question board is cleared for this session. And now I would like to invite Kota sir, Vice Chairman of the Committee on International Taxation, for the closing remarks.
Thank you, Rohan. And first of all, let me thank CA Rohan Solapurkar and from Singapore, and the other two gentlemen from India, CA Hitesh Gajaria sir and CA Uday Ved. I was just seeing the resume of all the three gentlemen. 37 years, 30 years, 25 years. I think almost 100 years of experience today we have been sharing with our participants. And of course, Rohan has got a 3 or 4 years experience, and so almost 100 years of experience. And a lot of things have been discussed. I think it's a very good seminar, I should say, like an eye opener. We need to do a lot of seminars like this. It's a good thing that we discussed about tax treatment and challenges for outbound investments in Singapore. As Hitesh Kedaria sir said, India is a happening country in the next 1 decade or 2 decades. So now more of outbound investments we have to discuss, and we came to know something about the challenges and treatments, tax treatments in Singapore. Various topics were discussed. I think we discussed about capital gains, then some of the protocols, then foreign tax credit thing, dividend exemption was there. Then even Pillar 1, Pillar 2 also were discussed. So it's a good, I should say, knowledge sharing session for all the participants. I hope everybody has enjoyed this particular session and got a lot of insights and I should say enlightened with the provisions. I wish that we keep calling you, sir, to in future also. We will be troubling you or taking your services, and see that more and more sessions like this is really handy for all the participants. I thank all the participants who have come here in large numbers and had your queries resolved, and also got an insight about the investments in Singapore. Thank you once again, sir, and I wish all of you Happy New Year in advance 2023. Thank you.
Thank you. Bye-bye.
Thank you very much.
Thank you.
Thank you, everyone.
Thank you for the opportunity.
Thank you.